We got the chance to sit down with him yesterday. Talked about a lot of things, including this looming fiscal cliff. Talked about business concerns as you head into the end of the year and even what to expect in 2014. Now, Bank of America has 55 million customers here in America. They represent 1 out of every 2 households through their many business lines. So Moynihan has a very good idea about what consumers are doing right now and if they are spending less because of the fiscal cliff. Here's what he had to say.
I'm more concerned about business behavior and slowing down than I am about consumer behavior. The people continue to spend. You continue to see them feel a little bit better. The housing's a little bit better. All the things that affect them, stock market levels are higher, are in decent shape, and consumers and the economy has been growing. The question was, will everything going on cause them to slow down again?
And what are you seeing from businesses right now, from your clients?
Beginning really almost a year and a half ago, businesses were getting concerned about the nature of the dialogue about the fiscal situation in Washington and in Europe and the issues that had to be dealt with long term and how it would affect near-term business in terms of what would be accelerated depreciation for investment in business, what would be the final demand. And so the uncertainty factor started weighing in. And it just caused everybody to be much more cautious, and they continue to be more and more cautious, worried about what might happen next.
You're a member of the Fix the Debt organization. You're worried about what happens if we go over the fiscal cliff. Lay out the scenario for how things would go down if we actually do move past January 1 without an agreement.
If you get lots of economists' projections, you'll see that the general view is the economy would have negative growth or slightly negative growth or a couple percentage points, whatever there is. But it's a near-term recession impact. And that wouldn't be good for the economy because it's been moving its way out. What's really after people is, will we be serious about fixing the long-term problems with America's fiscal situation? Basically, having more revenue and less expenses so we can get the thing more in line. And that's preoccupying people because they're worried about the longer-term issue. And so I think that if this doesn't move forward with a solution that actually starts to lay out a groundwork to solve the long-term issues, I think it could have the potential of being disappointing even if it is fixed. We
talk to a lot of CEOs who say that they already have to go to their boards and they have to lay out their plans for what they're planning on doing in January. Right. And they have to move forward with a plan that has an assumption that we don't get some sort of a solution. Right. Do you hear that from your clients?
Yes, absolutely. So, I think it's not January. They were actually forming these plans in August and September. So even leading up to that, people are becoming more conservative. And I think that's had an impact on what the growth would be in 13, all things being equal. And I think we're in danger if this thing strings out into 13, that you could start to have problems of what 14 would look like because municipalities and others make their budget in a half year, and then corporations make their budget basically early fall. And the decisions people are being thoughtful about are, should I build a plant? Should I add new equipment? What will the final demand be? All that is pretty much done for corporate America right now for 13. And you're really talking about what happens next. And so my concern is we need to get a solution that has both some near-term fixes, for lack of a better term, and then a longer-term viewpoint that they're going to be serious about it to give the confidence to have people actually think about 13 into 14 being a very constructive year and not think anything else.
You've been to Washington. You've spoken with lawmakers about this. Have you told them these concerns about this short-term fix after short-term fix and what it actually means?
I try to do 2 things. One is I obviously talk to them and say, I don't speak of Bank of America. We're a big company. We have 270,000 people. We have lots of people who can help us think through all these scenarios. I said, put yourself in the shoes of one of our clients. That's a manufacturing company with 500 people. And the amount of things that they face, they're probably more global than they were many years ago. So they're worried about whether China's going to grow as fast or what's happening in Europe. Then you add the United States uncertainty where they thought that was a rock that they understood, and suddenly they pull back. And then you add, they don't know the personal tax rates, they don't know what their employee tax rates will be, and they pull back. And so what I try to talk to them more about is what our clients see than what we see, because what I think we add value is we see 30,000 middle market companies in the country, and by hearing from them we can help articulate what they're seeing and how they're behaving.
Among many other topics that we talked about, we also discussed the state of financials and the upcoming Fed stress test. The banks have to turn in their capital plans to the Fed by January 7th. And so I asked Moynihan about the bank's dividend plans.
When we ask them, when we hear, we'll let everybody know. And I think we fared well last year, and I assume we'll fare well, but I can't share with you what we're going to ask for because we haven't really finalized it yet.
You have done a good job of capitalizing relative to your peers. Analysts have looked at that and said that makes them suspect you will ask to raise your dividend next year. Is that a fair assumption?
I tell you, when we get done, after we get through it, I'll tell you what we did.
Okay. You look at what the Fed's doing, and obviously it's got a big impact on the environment for banking. Some people call this QE infinity at this point, not just QE3, but now potentially QE4. What does this mean over the longer term, and how difficult does it make it to be a banker in this environment?
When you say what the Fed is doing, QE2 and things like that, they're trying to help the economy. And this is a big economy, and that's the thing that we have to be careful about as we think about the U.S. economy versus the rest of the economies of the world. It's so big that once it goes in a direction, it's hard to reverse that. Now, the good news is it has been growing. It's been growing relatively stable over the last several quarters. And if we can keep that going, it will materialize and produce the jobs and gain, not as fast as we all want. We all want this to be over. We want it to be back to 4.5% unemployment. We want 4% GDP growth. That's probably out there for a while. But it's going forward. So I think the key is, and what the Fed's been trying to do, is keep the economy going in the right direction. I think Chairman Bernanke has been extremely clear about that, and probably more clear than any Fed chairman before. What it does for banking is actually, on the one hand, it makes a very difficult earnings environment. Right. But believe me, I'd rather have higher interest rates because it means the economy's growing. If the economy's growing, we're going to do better as an industry. And so, we all want the economy to grow because that is a lot more fun to be around. There
has been the suggestion from some Fed watchers that the Fed would like to see interest rates go even lower in terms of mortgage rates and what you can offer. Right. If I was a banker, the idea of offering a 30-year mortgage at even lower rates, is there a point where you say, hold on, we can't make these mortgages anymore if the rates continue to drop?
Well, I think you have to go to the investors who actually own the assets, and there is an idea that if you get a mortgage now and it's so far below what we think is sort of normalized interest rates that it's, as we say, forever on your lips, moment on your lips, forever on your hips. I mean, that thing is going to be stuck with you for a long period of time. And I think we manage our balance sheet very close because that, and what we mean by close is our duration of our balance sheet's 2.5 years or so. So a lot of mortgage we have, we swap out the interest rate risk because of that as an industry and a company, and we're all doing that. But I think that there is an issue about how low nominally people go. It's just at some point. But the mortgage market's working well. I mean, it's just getting them all done. I mean, it's a lot of work to get this many mortgages through the system with all the rules and work we have to do. And so we're getting it through. We'll do more mortgage originations this quarter than we did last quarter, than we did the quarter before, than we did the quarter before. And we're back to year-over-year growth after we got out some correspondent business last year, wholesale business. And so we're pleased what's going on in the mortgage business. But we have a lot more people than expected in the good side of the mortgage business generating mortgages right now.
Welcome back to Squawk Box, everyone. Dow Component Bank of America is the second largest U.S. bank by assets. The company does business with 1 out of every 2 households in America. A year ago, it came under fire from some consumer groups when it announced new fees. There was a Wall Street Journal article yesterday. It suggested that Bank of America would push off higher fees into late next year. We sat down yesterday with the CEO, Brian Moynihan, and asked if that report was accurate.
I'm not sure. We are making decisions all day long. But let me tell you what we're doing in the consumer business. We look at the consumer business as different groups of customers. So we have what we call a retail business, which is the general America out there. Then we had a preferred business, which would start with higher income people and then we have our wealth management business. So those are 3 groups. And so in our general consumer business, we are about being a relationship company. When we mean relationship there, we mean your core banking account, your credit card, your debit card, and potentially a home or a car loan, and that's what we're focused on. So what we're doing is everything we can to drive relationship banking, and the more relationship people have with us, they'll be able to avoid fees and charges because it's a trade of value, and that's what we've been after. So there's a lot of talk about what decision we made, what day, and what day. I put it all in a broader context. In the retail team, in that broad group of American customers, 20 million checking holders at Bank of America, we make money today, but we need to keep working on the business system to be better for our customers and better for our shareholders. In the preferred team, which is about 10 million of our checking customers, that's a growth business. We've dedicated literally thousands of people to drive revenue growth there at the same time. And they're very different business models. And so that's what we've been trying to do.
So the idea of higher fees, because I've always thought of it as kind of in an airline industry, I don't expect them to start rolling back the fees that they charge for me to bring my bag on if I want to check a bag because they make too much money on it right now. Your thought is that the bank can continue to make revenue or make money off of this by getting them linked up with other products?
Right. So a lot of the fee stuff that we talked about for years, overdraft fees and the interchange fees and even the Card Act, which that's been out of our P&L now for over a year. So literally quarter by quarter the fees are stable and growing. One of the areas we've invested a lot is mobile banking. And why mobile banking? It's because what that allows the customer to do is have a much more intimate relationship with us in much more real time. On a given month, we have 22 million texts and emails we send out to customers warning them that their balance has dropped below $25 and they should deposit to avoid an overdraft fee. that kind of intimate relationship with that device that you carry around, like it's your child almost. That intimate relationship is so different for us to talk to that customer.
You've been able to bring down your cost structure pretty rapidly, more rapidly, and you have more advantages, I think, than a lot of the other big banks do at this point. Where do you kind of see that playing out over the next year?
Well, I think we continue to work the distribution network. So we said we were a year and a half ago we'd bring it on branch structure, and we're in the process of doing that. We've been doing it costs across the whole company, also including the cost of servicing the legacy assets, the mortgages from the old Countrywide transaction. So we've been bringing down the cost. It's what you can do. Our revenues are relatively stable, and will grow with the economy. Now we've kind of repositioned the company, $20-odd billion dollars of revenues a quarter. The question is, we've got to bring expenses down, and we're working in every aspect of it. In things like mobile banking, and things like data center consolidation, and things like repositioning some of the franchise you see out here to where the opportunities are today versus where they were a couple of years ago. All that fits into this, and we've done a reasonable job. We still have a lot of work to do.